Hi everyone, welcome to Deloitte's Debrief Tax webcast series in Asia Pacific. Our webcast today is from our Global Mobility Talent and Rewards series, and it's titled Asia Pacific Employment Tax and Immigration Updates. My name is Jack Wu, and I am a Mobility Director based in Deloitte, Singapore. I have the pleasure of hosting today's webcast. Now with me today are three speakers. Selena, who is a Mobility Director based in Deloitte, China. Himanshu and Yunju, they are Tax Senior Manager based in Deloitte, Japan and Korea respectively. You may access our bios on the left side of the screen. Now, before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. Now, if you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the survey on screen. Lastly, if you require an attendance record for this event, you will receive an automated email with CPE certificate after watching for 50 minutes. Next slide, please. Now, let me give you an overview of the topics we will discuss today. We'll first look into the highlights and latest regulatory updates on both individual income tax and immigration for Singapore, China, Japan, and Korea. And we will discuss the key considerations of the potential challenges and impacts from an APAC perspective. Now, before we close today for questions and answer session, we will discuss the suggested steps and actions to be taken by companies due to these challenges. Now, this brings us to our polling question for today. Now, as companies and cross-border employees, what are your most concerned items post-COVID-19 era? Now, there are 5 choices which you can click and submit, okay? The first one being pandemic control measures that delay or prolong assignment arrangement. The assignment periods may be of concern to companies and employees. Of course, again, implication to tax, okay? Because of the changing employment tax policies and regulations affected by COVID-19, or the borders control due to immigration requirement. Now, a lot of times there is also lack of effective communications with stakeholders and cross-border employees. Or maybe you don't have a clue at all at this time. Now, so please submit your choices. Excellent. We can see that tax implication is moving very rapidly. Not unexpected, yeah. And of course, during the pandemic control measures, assignments are delayed. Assignment terms, conditions, length of assignments, they change very constantly. Nobody chose that you do not know what is applicable. Oh, at least 10 of you, okay? But no worries, okay? Excellent. Okay, now, I'm sure during the course of our webcast, you will find a connection to your answer, okay? So now I will hand you over to Selena for China policy updates.
Okay, thank you, Jane. Good afternoon, everyone. In the following few minutes, I will share you with certain policy updates on both of China individual income tax and immigration. Well, here on the screen, we have already listed those updates that were announced by local authority in 2022 from individual income tax perspective. Well, as many of you are aware of, several preferential individual income tax treatment that already expired by end of last year has been extended by either 1 or 2 years. Now, let's have a very quickly look at each of them. Firstly, income from equity incentive plan of listed company can still be taxed separately from individual comprehensive income, provided that certain criteria and registration are satisfied and completed. And such preferential tax treatment has been extended through end of this year. Well, on the other hand, it's worth noting that a circular published in late of last year with aiming to enhance the administration on income derived from equity incentive plan. So company who is implementing equity incentive plan need to follow the regulation requirement by submission and reporting relevant information and a form to the local authority. So with that, the company should bear in mind of fulfilling any reporting obligation to ensure the compliance requirement. And secondly, by end of next year, a resident taxpayer can still make the election to report tax on annual performance bonus by either separately from other comprehensive income or combine such annual bonus income with other regular salary income, wherever the election made it more tax beneficial to the taxpayer. Well, the third update would impact foreigners working in China mainland. I know that most of company and foreigners are keen to understand the market trends with respect to non-taxable benefit in kind enjoyed by foreign employees. This preferential policy has been extended again through end of 2023, which will be beneficial in retaining foreign employees in China. So after January 2024, expenses on housing, tuition, and language training will not be allowed as taxable benefit for taxation purpose if no furthermore extension. So instead, a foreigner who is a resident taxpayer can enjoy the additional itemized deduction like a Chinese national as regulated, such as housing mortgage interest or rental, children education expenses, continuing education expenses. Well, these are three key extension updates in 2022 from China individual income tax perspective. For now, it is still not clear whether there will be further extension that allows the continuous special treatment on this income, or if there will be new taxation methods that to be introduced. So it is recommended that the company may continue to observe any further policy update and be prepared for internal workable backup plan based on the own situation. Well, other than these three extension updates, there are local tax incentive policy in some of cities and provinces in China, aiming to attract and retain talents, as well as motivate domestic economic development. So tax-free subsidy in Greater Bay Area, cooperation zone in Hengqin, and also income tax incentive in Hainan Free Trade Port are most famous ones, as they may reduce the effective tax rate to 15.5%. And the detailed criteria of the subsidy and the tax incentive will tailor the qualification of eligible taxpayers. So both of employer and employee should always refer to the latest criteria and requirement to assess their eligibility to apply for the subsidy and enjoy the tax incentive. Well, in the interest of time, we will take a few minutes to introduce the latest updated requirement for the policy in Hainan. So if there is any specific application in Greater Bay Area or Hengqin that you may interested to know, or you would like to require further details, please feel free to contact us offline. Next slide, please. Okay. The original incentive policy announced by Hainan government was in 2020, and the standard and conditions are very similar to those of Greater Bay Area policy. It also provides a similar 55% effective tax rate for qualified talents working in Hainan, which means the amount of tax over 55% of the annual taxable income would be tax-free. So the taxable income here would include comprehensive income, business operation income, and other income recognized by Hainan government. And additionally, Hainan policy is not limited to overseas talents only, but also applied to Chinese nationals. And for obtaining Hainan incentive, the application can be submitted through the annual filing process directly. Well, with the recent change of the new policy announced in September of this year, which required the qualified talents to stay in Hainan for at least 183 days in a calendar year. And for the requirement on minimum social security participation period and employment contracting period are removed and replaced by such physical presence condition for those non-particular occupations. And the new policy will be effective from January 1, 2023. So such new change may lead to a different eligibility result for enjoying the incentive in Hainan, as the physical presence become a mandatory requirement starting from next year. So with this in mind, in order to enjoy the tax incentive in Hainan from a long-term run, the company shall need to review the current employee assignment arrangement so as to ensure the future application can still be fall within the qualified condition. And on the other side, it is also worth to note that the requirement on employees' substantial business operation in Hainan is still retained and reiterated. So which is still one of the critical conditions for assessing the eligibility. Okay, next slide, please. Other than employment tax, immigration policy are changing even more frequently on my COBOL. And for the past half year, we have experienced a series of relaxed cross-border rules and updates in China. And look at the slides, and you may see that from early May of this year, PU invitation letter has been waived in majority of countries for work visa and business visa applicants. So this is really a good recovery, as the remove of PU approval costs around 1.5 to 2 months for the whole immigration formality to enter China. Well, another change is about quarantine, which is mandatorily required for cross-border travelers to China mainland. And starting from early of June, it is also kept from 21 days to 10 days, including a 7-day centralized quarantine and a 3-day health observation. So the change of quarantine policy also effectively reduced the total processing time for foreign employees' immigration formalities, and also save the overall business cost on relocation of assignees. And the third change is with effective from August 24th, foreign nationals holding valid Asia-Pacific Economic Cooperation Business Travel Card, we call it as APEC card, or resident permit for study purpose, will be allowed to enter China mainland without the need to apply for any new visas. So apart from those relaxation of policy, it is also worth to note that when traveling to China during COVID, besides valid entry visa, travelers are also required to stick a health declaration code in departing country. So the code itself may prevent the traveler from boarding the flight to China if not handled properly. As such code application policy has been updating from time to time, so both of the employer and employee are recommended to observe the latest requirement before making any travel arrangement. So that's all from what I want to share from China. Let me hand over now to Jen to talk about Singapore immigration and tax update. Jen, over to you.
Thank you, Selena. Now, for Singapore immigration, essentially, there are three important dates to remember. First September 2022, which was a month ago, 1st of January 2023, and most importantly, 1st of September 2023. Now, the landscape of Singapore immigration will change very drastically starting next year in September, when Compass, which is a point-based immigration system, will be implemented. Now, but before we take a closer look at Compass in the following slides, it is important to note that with all these changes that we are going to discuss today, the overall aim of the Singapore government is to ensure that top foreign talents with high salaries are hired to commensurate the local employees so that Singapore has a first-class workforce globally. Now, a month ago, 1st September 2022, the minimum qualifying salary was increased for both employment pass and S-pass application. In fact, there were multiple increases of minimum qualifying salary for these two work passes in the space of the last 2 years. This year, the government aimed to improve work pass application efficiency by reducing the fair consideration framework and advertising requirements from 28 days to 14 days. Processing time of work passes have also been reduced from the normal 15 work days to 10 days. This allows companies to be more efficient and definitely more competitive in the talent market globally. Next, 1st January 2023. We see the introduction of One Pass, which is a personalized pass where foreign talents from top companies holding a monthly salary of 30,000, they can apply for this pass. Now, applicants need to prove their individual eminence and have to work in a reputable company. The pass is valid for up to 5 years and is renewable, and it offers a lot of flexibility in terms of whom the holder can work for. Now, next year in September 2023, you will also see an increase in the qualifying salary for personalized employment pass, which is the PEP, to 22,500. And also, you will also see again an S-pass increase in the salary. In addition to that, the exemption salary for the fair consideration framework has also been raised to 22,500. Now, ensuring that all jobs with a salary below the amount will need to be advertised for a total of 14 days. Next slide, please. Now, perhaps the biggest change here is with the Compass implementation in 1st September 2023 next year. Now, as introduced, Compass is a point-based immigration system where EP applications will be assessed on 4 foundational and 2 bonus criteria and need to obtain a total of 40 points to qualify for an EP application. Now, on this table, you will see that there are 2 criteria based on individual eminence, and such as the minimum threshold on salary and education, and 2 firm-related criteria, which is the diversity and percentage of local workforce population. Now, to score 20 points for C1, which is the individual's salary, will need to be at the top 90 percentile for the benchmark salary of the PMET. Now, what is PMET? PMET is the professional, manager, executive, and technicians. Okay, so this salary is benchmarked against the sector of the PMET, and now between 65 to 90%, 10 points will be awarded. For C2, you will see that an individual with qualification from top-tier institution will score 20 points, and those with degree equivalent qualifications scoring 10 points only. As mentioned, there are two firm-related criteria, one on diversity, which measures the percentage of nationality of the individual applicant versus that of the PMETs within the company. If the nationality is 5% or lesser, 20 points will be awarded. Now, next, we can see that for C4, it measures the percentage of local PMET versus the percentage of foreigners in the company. The higher the percentage of Singaporeans in the company, the higher the points awarded. Next slide, please. Now, there are also two bonus criteria, as mentioned, where employer and applicants can score some points on. For individuals hired to work on jobs that has a skill gap, where the job title is on the shortage occupation list, 20 points will be awarded. Now, the first shortage occupation list will be made available to the public in March next year. Now, in regards to C6, the government will be releasing more detail on the innovation and internationalization of activities, which will allow the company to score 10 bonus points. Overall, from this, we can see that the aim of implementing Compass is to enable employers to select high-quality foreign professionals while improving workforce diversity and building a strong Singaporean core. As of today, Compass is still a work in progress by the government, and more information will be released as we move closer to 1st September 2023, which is the implementation date. Now, next slide, please. Now, next, we would like to provide some updates on Singapore individual tax and social security. Firstly, with effect from the year of assessment 2024, which is the income year 2023, there will be an increase in the marginal income tax rate from 22% to 23% for annual chargeable income exceeding 500,000 and up to 1 million Singapore dollars. There will also be an increase in the marginal tax rate from 22% to 24% for annual chargeable income exceeding 1 million Singapore dollars. Now, you could see from these changes that it is expected to impact only the top income earners. Secondly, the government has also previously announced that the contribution rates to the CPF, which is a Central Provident Fund, which is the Social Security and Pension Scheme in Singapore, will be raised gradually for Singaporean and Singapore permanent resident workers aged above 55 to 70 years old. The first increase will be effective on January 1st, 2022, and the next increase taking effect next year in January 1st. The upcoming increase in 2023 is 1% for the employee and 0.5 to 1% for employer, as shown in the table. The proposed change, as we can see, is in line with the government's effort to strengthen support for older workers by growing their CPF savings and building their retirement nest. Next slide, please. Now we could see that another change relating to the removal of the concessionary tax treatment on the employer's contribution made on or after January 1st, 2024. Now, this is the contribution made to an overseas mandatory pension or provident fund, where such contributions have not been recharged to or claimed as a corporate tax deduction by the Singapore entity. Now, accordingly, all employers' contributions made to any overseas pension or provident fund will be taxable in the hands of the employees. Now, regardless of whether the contributions are considered mandatory or non-mandatory during the Singapore employment. The employer's contributions will be tax deductible to employers in Singapore as per normal tax rules. With the withdrawal of this tax concession, the tax liabilities of the foreign employees working in Singapore and the tax cost to the employer, that is, if the employee's tax are borne by the employer, are expected to increase. Now, the last update relates to the claim of foreign tax credits in Singapore. The time frame to claim foreign tax credit in the employee's tax returns has been revised from 2 years to 4 years with effect from the year of assessment 2022, which is the income year 2021. Now, the time frame for the foreign tax credit application related to tax returns for the income year 2020 and earlier would remain as 2 years. Okay. So that sums up the tax update for Singapore. So let's move on to the next slide. Himanshu, over to you.
Thank you, John. Good afternoon, everyone. I'll talk through the immigration and employment tax updates from Japan side. So first, we'll talk about the immigration related updates that were announced recently. As you all know, Japan had shut down their borders during COVID to curb the spread. The Japanese government was heavily criticized for having hard rules for quarantines and entry, resulted in foreign nationals who were non-resident of Japan not willing to enter to Japan until all the relaxations were announced. We have seen some of the international assignments were cancelled, delayed due to these rules. Since March of this year, the Japanese government has been continuously taking steps to relax the entry and quarantine rules, but they were not considered enough as they had their own limitation and challenges. Now, as the number of COVID cases declining worldwide, Japan government has decided to reopen their borders and reduce the quarantine for vaccinated individuals. There are 4 major changes that were announced recently. So we'll look into them one by one. The first one is relates to visa requirement. During COVID, Japan government has suspended visa waiver program, requiring everyone to acquire visa to enter into Japan. Foreign nationals who wanted to enter to Japan for short-term business trips were facing a lot of challenges due to this suspension. As per the new rules announced, the government has decided to resume visa waiver program effective October 11, 2022. In addition to this, pre-clearances that were given by the Japanese government and were put on hold to the EPIC business travel card would also be resumed. The other announcement that was made was related to pre-arrival and post-arrival COVID test. During COVID time, individuals entering into Japan were required to take pre-COVID test based on their vaccination status and the country they're entering from. Japanese government has stipulated prescribed format for this test, and the format was considered as the biggest challenge for all the individuals entering into Japan. The new rules that were announced recently, pre-arrival COVID tests are no longer required if one is fully vaccinated. So that brings a good news. Now, when we say fully vaccinated, it means the person should have 3 doses of vaccination and carries a valid vaccination certificate when entering into the Japan. In the absence of vaccination certificate, one is required to take pre-arrival COVID test and need to present the certificate while entering into Japan. Post-arrival tests are also abolished for individuals who are fully vaccinated. Next slide, we'll talk about the third and the fourth requirements. The third requirement or the third change that has been announced relates to vaccination requirement. Individuals entering into Japan are required to be fully vaccinated, 3 doses of valid vaccination, and need to present the vaccination certificate at the time of entering Japan. The certificate must show that you have taken 3 doses and almost all the vaccines given in the emergency use listing of WHO are approved. To name some of them, vaccines manufactured by Pfizer, AstraZeneca, Moderna, etc., are already approved by the Japanese government. The list is quite comprehensive, so almost most of the vaccinations are approved by the government. The last update on immigration or border measure was related to ERFS, Entrance Returnees Follow-up System, which was introduced as a requirement to obtain visa to enter into Japan. Now, this ERFS certificate is no longer required. This system has been abolished, and this is not required for visa applications. And the measure to limit the entry of foreign tourists to those on package tour was lifted as well. This concludes the updates for relates to immigration, and from here we'll move to the tax side. So next slide, please. We have 3 updates from the tax perspective, from the employment tax perspective, and the first one relates to special housing credit, also known as housing loan deduction in Japan. This was available to individuals who buy home in Japan using loans financed by the Japanese institution, and this scheme was used as one of the scheme to lower income tax or to devise your income tax in an efficient manner. The scheme was due to expire on December 31st, 2021. However, with the new reforms announced by the tax office, the deadline, the application period has been extended by 4 years to December 2025. This brings a relief to the individuals who are still contemplating to buy a house in Japan using the home loan. There are a few more changes to this rule. The income threshold, which was earlier 30 million Japanese yen, has been reduced to 20 million Japanese yen, and also the deduction rate has been reduced to 0.7% from 1% of year-end loan balance. While the extension of application by 4 years is definitely a welcoming step, but reducing the threshold to 20 million may restrict the number of applications for home loan deduction. But this will move to the next change for Japan. Next slide, please. The next change is on the updates that were made towards assets and liabilities reporting. NTA, the National Tax Agencies in Japan, has expanded the scope of assets and liabilities statement. The intention is to bring high net worth individuals into the purview of this regime, while the current rule requires individuals to file assets and liability statement if they are required to file a tax return and meet the criteria of having a certain amount of assets as of December 31st. In addition to the current requirement, tax office has announced that individuals holding assets in the amount of 1 billion Japanese yen or more are required to report their assets and liabilities regardless of income. So this is an addition to the current rule, and also the deadline to file the statement has been changed from March 15th to June 15th. This is because there were a lot of concerns raised by the individuals that March 15th is very early to collect all the information to file this statement. So it's while the deadline extension of deadline is a good news, but individuals who have 1 billion or more of worth of assets, they need to make sure that they have to file this report within the timeline. The next topic, or the last topic for Japan, is relates to retirement income. So next slide, please. Japan has tightened their rules on retirement income benefits where the employment is under 5 years. So in Japan, retirement income is considered as beneficial and is taxed separately, and it's being used by employers to attract talent as well. So here we in this slide we have tried to show the impact after the new reforms come in place. So if you look at the slides, the current or the erstwhile rules, if the employment is up to 5 years and the amount of retirement income is 10 million Japanese yen, the taxable amount would have been 4 million Japanese yen, following if we calculate the retirement taxable income based on the formula that was there up until 31st December 21. Recently, the new changes that were announced, the taxable amount, if we calculate by the new rules, it would be 6.5 million Japanese yen. So there's clearly an increase of taxable income by 2.5 million Japanese yen, which is not in favor of individuals. So they may end up paying higher taxes in Japan if receiving retirement income that exceeds 3 million Japanese yen. Why I said 3 million? Because 3 million, if your retirement income is within 3 million Japanese yen, there are no changes to your retirement income taxation. But if it exceeds 3 million Japanese yen, the portion that exceeds 3 million Japanese yen would be taxed at a higher rate. So there wouldn't be any beneficial treatment available for anything that exceeds 3 million Japanese yen. So it might be disadvantages if the amount exceeds 3 million Japanese yen. With this, we will conclude the Japan part of it, and I'll hand over to Yunju to go through the Korean part of the discussion. So Yunju, over to you. Thank you, everyone.
Thank you, Himanshu, for sharing us the updates in Japan. Now let's take a look at the latest tax and immigration regulatory updates for Korea, and I will talk about the tax part first in the next 4 slides. For our income tax calculation, we either apply a progressive or a flat tax rate. A progressive tax rate system leads to higher tax rates to higher levels of income, while the flat tax rate system results to the same tax rate regardless of the levels of income earned. In general, taxpayers in Korea are obligated to file and pay for income taxes using the progressive tax rates, but there is an exceptional case where a flat tax rate is applied. This exception is for the foreigners who have worked in Korea for less than 5 years. According to the current income tax law, the progressive tax rates range from 6% to 45% depending on the income level, and the flat tax rate is 19%. During July of this year, there were proposed tax revision announced related to both Korean income tax rate. So first, let's look at the progressive tax rates. If you compare the tax base for each row marked with red boxes in these 2 tables, you'll be able to see that the tax base amount has increased by 2 million won for the first and second row and 4 million won for the third row, while the tax rate remains the same. The expansion of the tax base for 6%, 15%, and 24% was proposed for revision in order to reduce the income tax burden slightly by middle-class income earners in Korea. Next topic will be regarding the flat tax rate of 19% in Korea for the foreigners. As mentioned in the previous slide, Korea's individual income tax rate on employment income is composed of either progressive or a flat tax rate. Flat tax rate is only applicable for 5 continuous tax years to foreign nationals who started to work in Korea before December 31st, 2023. And we could say the flat tax rate is more beneficial for whose gross income level is roughly greater than 140 million won. It can really affect the high-income individuals because if their length of stay in Korea exceeds 5 years, then the individuals will no longer be eligible for the flat tax rate and are required to apply progressive tax rate, of which will tremendously increase their tax due. However, according to the proposal, this 5-year rule is expected to be removed starting from the wage income generated on or after January 1st, 2023. It will allow the foreigners who started working in Korea before December 31st, 2023 to continue to apply the flat tax rate without any limitation. On the next 2 pages, we have provided illustrations to further grasp about the flat tax rate about 5-year rule abolishment. Let's move on to the next slide. Let's assume that there is a foreigner who enters Korea to work for the first time in January 2022. Following the current provision, this individual is eligible for the flat tax rate only up to 5 years from their entry year. So in this scenario, it will be until 2026. The foreigner is then required to switch to the progressive tax rate starting from 2027. If the proposed revision is approved, the above foreigner will be able to enjoy the flat tax rate without limitation from the first entry of Korea. Next slide, please. Here is another plot. In this slide, a foreigner came to Korea in January in 2017, so the flat tax rate should have been applied for 5 years from 2017 until 21. For the following years after year 2021, the individual is no longer be able to use the flat tax rate, so the progressive tax rate should have been applied. Although applying the proposed tax revision, the flat tax rate would have been applied in the same way as the current law from 2017 to 21, and the progressive tax rate would be applied to income generated from January to December 22. If the revised law is passed and 5-year limitation is removed, then the individual will be able to go back to the flat tax rate starting from income earned in 2023 and onwards. The individual length of stay in Korea will no longer affect the flat tax rate eligibility, as he will be able to apply the flat tax rate again starting from 2023. We cannot guarantee at this point whether the proposal on the tax rate will be approved by the National Assembly or not, but we'll keep you updated once there is an announcement made around December this year. These are the 2 recent major updates I can share regarding the Korean income tax law. Now, I will talk about the recent Korean immigration updates in the next 2 slides. There are 3 things I would like to share for the immigration policy update regarding to COVID-19 in Korea. First is on re-entry permit exemption. The re-entry permit exemption has been suspended for the past 2 years due to COVID-19. So if a registered foreigner leaves Korea for a while and tries to re-enter Korea with his existing resident status, the individual was required to apply for re-entry permit in advance of leaving Korea. As of April 1st this year, the suspended re-entry permit exemption has resumed, which means long-term visa holders who have completed their alien registration process will be able to travel abroad without obtaining a re-entry permit. However, the exemption varies depending on the visa status of the individual. The second one is related to COVID-19 test requirements. As of September 3rd, there has been an update to remove the obligation to submit a COVID-19 PCR certificate for all the Korean and foreigners. Additionally, from October 1st, PCR test, which was mandatory within 24 hours from entering Korea, has been also removed. There were various factors for such removal, as the rate of confirmed case from overseas has dropped in September compared to that of August, and most OECD countries already eased PCR test obligation. Therefore, most restrictions related to COVID-19 testing, which was previously required for all individuals entering Korea after traveling abroad, have been removed. Next page, please. For the last topic, let us look at the KETA. KETA is an electronic travel authorization system which is valid for 2 years from the date of approval. It has been granting travel permission to the eligible foreign nationals who wish to enter Korea freely without a visa. Currently, there are 107 visa-free foreign nationals who can apply for KETA. but as of November 1st, it will be extended to 112 countries. With KETA, non-profit activities such as attending the meeting, research, or conferences are allowed. But if the individual provides service or work for a Korean company, work permit will need to be applied. This has been Korean side for the latest tax and immigration updates. Thank you for your attention, and I will hand over to Jen.
Thank you, Yunju. Now that sums up the policy updates for China, Singapore, Japan, and Korea. We will next move on to discuss the challenges and impacts facing APAC on tax and immigration.
Thank you, James. Well, let's move to the next page and see what challenges and impact that might bring to the company and the employee from employment tax perspective first. Firstly, the changing tax policy for what my other coworkers just shared, like tax updates, tax rate updates, tightened measure of income paid, and also cease of beneficial tax treatment may all bring increase of tax burden either to the company or the employee. So even the change of policy is predictable. Company will still need to take proper pre-planning and also internal budget estimation and also timely communication with the stakeholder and employee so as to limit the impact from policy change and also ensure the smooth internal arrangement. And also secondly, in the past 3 years, uncertainty brought by COVID may disrupt or delay the termination of employment. So change of stay period may also impact the residency status in both of home and host country, which results in different tax implication and filing requirement. So with that, the company and employee would need to conduct necessary review and assess if the filing position is fully compliant with the local rule so as to mitigate any potential negative impact and risk. And thirdly, for assignees stuck in host country, either due to local lockdown, lack of flight, or failure to get a valid visa in the next assignment country, may also have the possibility to trigger double taxation issue. So for example, if a foreigner terminated China assignment by end of August, but it can his physical stay in China for another few months while waiting for his working visa to the second host country like Singapore, he may still have the possibility to be liable to China tax on those salary received after August, even it is paid and borne by the entity in Singapore. And of course, case-by-case analysis would be necessary on individual basis. Last but not least, for remote worker, companies should comprehensively consider the impact on both of employment tax, social security, and immigration in both of home and host location. And also permanent establishment exposure should always be one of the consideration when the work is performed remotely from another country. Well, Jen, here are my sharings. Now back to you.
All right, thank you so much. And we could see from all the immigration updates by my colleagues earlier that COVID has definitely created an upheaval in the immigration and business travel space. Most of us had a rude shock how this situation has perhaps permanently changed the immigration and business travel landscape. Now, due to the situation, countries now need to change the way that they have been doing things. Do they allow more foreign talents migrate to relieve the shortage in local labor market? Or do they focus on upskilling and develop local core? For example, in Australia, they have taken the position to encourage foreign talents to take up position in areas of labor shortage, whereas countries closer to us like Philippines and Indonesia, they have placed strong focus on upskilling their local talents and creating jobs for the local core. Now, in APAC, we can see that there is a trend that countries are balancing with hiring foreign talents and developing the local workforce. Another trend that we observe is the use of targeted migration in various APAC countries. Now, this stems from the aspirations of government to want to create jobs in certain industry or sectors. For example, again, for Australia, we can observe that there is a priority processing of PR applications for health, education, and aged care sectors. Whereas in Singapore, the government will give a longer validity of work pass for those from the technology industry. Now, next, making migration pay. Some governments are increasing government application fees, but fortunately for you, our friends and clients, our Deloitte service fee remains very, very competitive. Now, countries are also implementing and granting immigration visas to high net worth individuals who invest a certain amount to obtain immigration and permanent resident status. So Malaysia, for example, they have implemented the premium visa program where individuals may invest in Malaysia and pay a high application fee to enjoy long-term resident status of 20 years in Malaysia. All in all, we can see that most governments are balancing hiring foreign talents and developing the local workforce. While not closing their borders to foreigners, a protectionist mechanism are put in place in most APAC countries, especially during this difficult period. Next slide, please. Now we shall now move on to look into strategies and actions companies may adopt to overcome the challenges. Over to you, Himanshu.
Thank you, John. So we'll look at some of the strategies and actions that employers may think of from the employment tax perspective. There are mainly 3 points that we would like to state today. First is COVID-19, as you know, has changed the dynamics of mobility, and companies need to be more agile in their policies and adjust them whenever required. For last 3 years, we have seen remote working as a new normal for the entire world, and employees would expect that to continue even in the post-COVID era. So companies need to make sure they are ready for that, and they have to have FAQs in place. They have to have solutions in place for that for after the pandemic. Second thing is on companies need to pay attention to the tax policy changes and updates to avoid any complex situation and adjust the mobility policies accordingly. Third is seek professional advice such as Deloitte or on the comprehensive tax issues, especially cross-border tax issues, because in case of remote working and all, they may trigger cross-border issues sometimes. So the companies need to make sure that they are addressing those issues before they become complex and complicated. With this, let's move to the next slide on strategies and actions for immigration, and then I'll pass on to Yunju to talk through some of the strategies and actions for immigration. Over to you, Yunju.
Now let's look at the strategies and actions that the company should take in relation to the expats immigration. The experience from previous economic crises during the current pandemic for the past 3 years suggests that the COVID-19 crisis impacted the entire world, and expats had no exception on this. Many countries had closed their borders and banned flights in response to the COVID-19 outbreak, resulting too much complicated immigration procedures than before. Though recently, COVID-19 restrictions for traveling have been lifted for most countries, and they have started easing some of the COVID-19 lockdowns. For the immigration aspect, there were additional procedures required by the Bureau due to COVID-19, but as the situation is getting better, we can grasp that the restrictions are disappearing and procedures are getting simplified. Therefore, at this point, we would like to examine in 4 areas what actions the company should take in relation to the expats immigration. First is regarding the mobility management. We all know that due to COVID-19, many companies delayed international assignments, canceled short-term assignments, and even stopped and repatriate assignees. With the birth of the new normal, it is difficult to predict when things would get better for the world economy. But at some point, we know that things will eventually be settled down, and the employees will again actively start working abroad. It is important for the company to implement a strategy to ensure that expats management goes smoothly and modify the internal policies timely according to the country's compliance requirements and changes. And not only this, but for the expats to obtain necessary immigration formalities, the company needs to look closely in advance of the relocation for the eligibility of pre-arrival assessments as well as to support post-arrival management. Secondly, a successful communication with the expats is key to assignment success. One of the primary challenges of the expats may be a culture shock and family issue. Effective communication and close monitor from the HR group may greatly help expats and their families to anticipate and to deal with common difficulties associated with moving abroad. Companies should be also duty-bound to manage compliance risk for the expats. It needs to utilize market-leading technology for visa tracking and mobility data analysis. It should also endeavor to fulfill the comprehensive compliance requirements related to immigration needs, such as tax and social security. Finally, we all know that immigration and income tax laws remain as a significant driver for the expat management because the company's mobility policy changes as the law changes, and all the necessary procedures must be also updated. Therefore, the company should be aware of the current laws and should actively participate in interacting with the immigration authorities on interpretation of rules and regulations for the expats assignments to be successful. Thank you for listening to the Korean immigration updates, and now pass on to Jam for the Q&A session.
Thanks, Selena, Himanshu, and Yunju. That brings us to the end of our today's discussion. Now, we do have some time now to respond to some of your questions from the audience. Okay. Let's take a quick look at the interesting questions that are coming through. Right, we have one here for China. This is a trend, okay, for compliance. So what advice are you giving to companies trying to stay ahead of the compliance trend around data collection? Selena, would you like to take this?
Sure, okay. I think data collection conducted by various government authorities is indeed a trend in Asia Pacific, or even we can say globally. And these are closely related to our strategy talked in earlier slides. So for example, firstly, to review its international assignment policy, talent selection rules in accordance to the local regulation and practice of the destination city. And secondly, pre-arrival assessment from tax, immigration, and social security perspective for the targeted talents is essential to both the company and the individual employee. So the employer and employee fully understanding of both of the home and the host country compliance requirements are very important. And lastly, continued post-arrival management from tax, immigration, and social security is compulsory to mitigate the exposure under the enhanced administration environment. So I think implementation of technology tool would also facilitate the overall management of the exposure arising from tax, immigration, and social security in multiple countries.
Great. Okay, thank you, Selena. Hope that answers your question. Now, we have another query and which I can help to answer, and that is what is a PU invitation letter? Okay. Now, the PU invitation letter is essentially the company invitation letter for those that are traveling to China. Now, why is this so significant? Because the removal of the PU letter requirement, okay, recently meant that the processing time for individuals to be able to travel for business trips to China is reduced by 1 to 2 months, because the processing time for the PU letter was 1 to 2 months. So it has significantly enabled business travelers to be more efficient in China. Right. Right. Let's see. We have one question for Korea. Now, should be a quick one. Now, is there a possibility that Korean income tax filing due dates will be extended due to the COVID-19 situation? Didn't you want to take that? Yep.
Yeah, sure. So in the past, there were some cases where the deadline for Korean income tax return has been extended. For example, the filing deadline for 2019 income tax return was extended for 3 months. And again, the following year, Korean income tax filing deadline was also extended for again for 3 months. But for that time, the extension was only applicable for those individuals who own small business and certain types of business. So for this year, 2022 tax year, we will have to monitor the announcement made by the tax authority, which will be expectedly around March next year.
Great, thank you. We have one interesting one for Himanshu. Okay. I like this. Okay. Do you think if the weakening of the Japanese yen would have any impact on individual taxation?
Actually, a very good question, Dan. To be honest, so many companies, so many individuals have been asking this question to us. Japanese yen, if you see, has declined more than 20% this year compared to dollars. And for expats receiving their salary in home countries, this may impact their taxes in yen terms. However, if they are on a tax equalization assignment, generally the companies would do the true up, but the companies may end up spending a lot as overall cost for the assignment. Further, for individuals having stocks in overseas accounts, and if they are taxable in Japan, taxability in Japan, they may end up having higher capital gains because of the weakening in Japanese yen. So if the stocks were bought, say 1 year or 2 years back when the yen was appreciating, and if they are selling it now when the yen is depreciating, they may end up having a lot of capital gains, which may impact them adversely. So it's a tricky situation this year. Yeah. Hope that answers the question.
Yeah, definitely. Thank you, Himanshu. And yeah, looking at the time, this is unfortunately all the time we have for. Okay, so now special thanks to all of you who were able to join us today, and we would like to encourage you to fill out the short survey that will pop up on your screen momentarily, and let us know what you think about today's program. Now, if you have joined us late, please note that the presentation will be archived for future viewing. So if you feel that others would benefit from this webcast, please share the webcast via the share this icon or have them visit the debrief's websites. We will respond to all the questions submitted during the webcast in a couple of weeks. It looks like, yeah, there are some questions that are coming through that we may not have time to answer them. Now, also, if you think of any other questions or comments later, please feel free to reach out to either me or any one of the speakers here. Definitely more than happy to have a chat with you. Okay. Now, please don't forget to tune in to our next scheduled webcast from the transfer pricing on 8th of November, titled Renewables and clean energy, new transactions and transfer pricing themes. Now, at last, from all of us at Deloitte, thank you very much for your participation in Deloitte's Asia Pacific Tax webcast today. And goodbye, everyone.